Hello and welcome to the i3 podcast, Conversations with Institutional Investors. My name is Wouter Klein and I'm the editorial director for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. That's the letter I and the number 3-invest.com. There, you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners from around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. Please enjoy the show. In this episode, I'm speaking with James Richards, co-portfolio manager of Fidelity International's Transition Materials strategy. James runs a strategy that invests in stocks of companies that are exposed to materials that will play a crucial role in the energy transition. And it's not all about copper or lithium. James keeps his investment universe wide and includes commodities such as animal fats and wood chips. We discussed the spike in rare earth materials earlier this year. We also look at why this is a supercycle, but unlike the previous China-led one. And finally, we explore whether this strategy correlates with the Australian economy and its emphasis on materials and style factors, including value. Enjoy the show. James, welcome to the show.
Hi, Victor, and thanks very much for having me.
So let's start at the beginning. What are transition materials and why should institutional investors care?
I think that the transition is one of the big structural thematics of the next couple of decades. And transition materials are what I call a wide range of commodities and materials that benefit from the process of the transition. And in many cases, the demand driven from the transition, coupled with the fact that it has never been so difficult to bring on new supply of a number of commodities, will create the conditions where, what I think could be the next super cycle for a wide range of commodities. And this is a very, very investable thematic in my view.
Before we get to the super cycle, can you tell me a little bit about where this idea came from? Because I understand this was more of an analyst-driven idea to set up the strategy. Is that right?
Yeah, I mean, I think normally ideas are born in the in the product team, and then they go and find a portfolio manager. This one is something that came out through hours and meetings and the sort of the work that we were doing around the commodity space, and the same themes started to come up again and again. First of all in copper, but then we began to get increasingly excited when we saw the same themes coming up across a wide range of commodities. And as far afield as vegetable oil and animal fats, and it was then that we saw that there was a sort of wide-ranging and quite diversified investable thematic here.
So what's the story with animal fats?
Well, animal fats is the renewable diesel chain, particularly in the US, but also more widely, is fueled by animal fats and vegetable oil, and there is there is a finite supply of these things, and so you have to incentivize it, and the only way to incentivize new supply is through price. And the demand that has been created by stricter regulatory standards and stepping up of requirements, really places a challenge on those supply chains.
Yeah, so is that in your portfolio, animal fats and oils?
We certainly think that the vegetable oils and animal fats is a very interesting long-term thematic, yeah.
Okay, interesting. So coming from themes that you saw in copper, and copper is of course a key material in electrification. So is this transition the story to renewable energy? Is it just about electrification, or are there other themes involved in this as well?
So, I mean, if you look at the sort of the current opportunity set, electrification is an obvious one. It has various aspects. Renewables is one obvious aspect. Electric vehicles is another. And if you think about sort of the grid requirements of the increased demand for electricity, that also has some pretty profound implications. But it's not just electrification. If you think about sort of hard to abate areas like steel production, maritime fuels, aviation fuels, the circular economy is a very interesting area. It's a much wider area than just electrification.
And I think you've mentioned digitization and urbanization as two key thematics that are related to the transition materials in particular.
I think one of the interesting aspects that you get here is that you get demand that is driven by the transition, but then you have a lot of other structural demand drivers that are also facing in the same direction and pulling on the same commodity demand chains. And so, for instance, AI and data centers, will drive demand for copper and other commodities. But also, the industrialization of India and Southeast Asia, as they start to hit levels where commodity intensity picks up quite dramatically, they're essentially be in competition with the transition and data centers for scarce supply of commodities. And that is quite exciting, I think, in terms of compromises will have to be made. I mean, if you look at the sheer population size in India and you put a sort of average peak commodity intensity on it, like the numbers are mind-boggling. And so, compromises are going to have to be made. And the only way that you get those compromises made and the signal that you get to get substitution and all the ways to get the numbers to work, the only way you can get there is through price.
So there's a couple of big trends involved. You just mentioned one around the supercycle in commodities. So when you sort of look back over time, have we had some of these supercycles before? I mean,
I do have a history degree, but I'm not much of a history student. So I'm kind of more focused on the most recent, which is the early years of my career were the China-driven supercycle, and that was one of the reasons where I saw clear echoes of what I was seeing today, versus what I was seeing there. I was seeing above trend demand for commodities driven by China hoovering up pretty much every commodity in sight, and decades worth of underinvestment in commodities at the time. So you had a relatively curtailed supply side, and that's really important. Is in order to make money in commodities, the supply side has to struggle to keep up with demand. And so, commodity with 20% demand CAGR, you're not necessarily going to make money if the supply side is elastic. And so, that supply side is really, really important. But it is a different supercycle, I think, from the China-driven supercycle, in that the China-driven supercycle, I think, mainly had winners. Whereas in this supercycle, I think, there are clear winners and losers in terms of demand, and the transition kind of gives the clue to that, in that thermal coal demand should decline over time. Oil demand should decline over time. We're talking longer term here, and there are areas like, I think, although there are some demand benefits for steel, the process of decarbonising steel is quite difficult and expensive. And so, I think there's some difficulties around that. And, I'm in Australia, and, there's a school of thought which says that iron ore is benefited by the transition. I don't really believe that. I think that iron ore, and particularly lower grade iron ore, is one of the commodities I have big question marks on a 10 to 15 year view.
Why is that? Because you could imagine that, steel is still used in some of the infrastructure. I mean, you think of windmills, probably mainly carbon fiber, but there's still elements of steel.
Sure, involved. But if you're going to produce low carbon steel, the miners are working with the steel companies on technologies, but there's a lot of unanswered questions around what the cost implications of that are, what the capital implications of those are, and who's going to pay for it. And so I think that I find it difficult to see a world that doesn't use Pilbara iron ore. But I just don't know exactly what that world looks like, and what the implications are for their position on the cost curve.
Yeah, yeah. So another element of this super cycle that is relatively unique to this one is there's an element of a decommoditisation of certain materials. And I think it's an interplay where ESG credentials, geopolitical alignment, and some processing capabilities can cause changes in prices and cause some price premiums. Can you explain that a little bit?
So this is something I believe in quite strongly, and there is active debate, and you definitely come across people in the industry who disagree with my point of view on this. But my point is this: is that essentially, as we begin to look for different things in a ton of commodity product, the features that we need to promote are going to have to be incentivized in some way. So if you want a low carbon ton of aluminium, you're going to have to pay a premium for that. And if you look at it producers today, you get some people who do get premiums for that, and you get some who don't. And there are some commodities where it is quite difficult to see these premium. But we've seen a really interesting example this year in rare earths, where the world has priced rare earths for the immediate part, for the last few years, on essentially the China price, and supply chain security suddenly come right to the front of people's focus, and the US government has done a deal with a large US rare earths producer this year, giving a price floor which was very significantly above the China price, and so if you particularly in a world where you mind about the security of your supply chain, there are areas where you're going to have to pay a differentiated price, I think, to incentivize that.
Yeah. So the rare earths were a bit of a outlier, I think, in recent times, where they spiked up and I think more recently came down a bit. But I remember you talked about like the Teslaization of rare earth stocks. Can you explain that a little bit?
I've been doing this for 20 years, and I'm kind of used to generous participation in metals and mining being sporadic and selective, and multiples generally being quite low. And you've seen in various spaces this year the multiples suddenly expand dramatically as I guess a wider investable public has come into the stocks. And as rare earths were right at the forefront of attention, the multiples did expand very, very dramatically, which was which was very pleasurable all around, I think.
Yeah. So did you do some profit taking on that then? Or?
I think Fidelity would really like me not to answer that.
All right, fair enough. So rare earths are intricately linked to China. And I think we've seen in a number of transition materials where China comes up. I saw somewhere a statistic that they already control 70% of global mineral refinery capacity. That makes you think, are there geopolitical elements that you have to be aware of when you invest in this space? Because obviously there are some tensions between China and some of the Western developed countries. If they have a sort of a stranglehold over some of these materials, that can potentially impact valuations. There might be strategic considerations that come into play. Is that something that you keep in mind when you look at this?
Absolutely. Rare earths, as you say, is a really good example. It's not 70% of processing in rare earths. It's more like 90%.
Yeah.
And magnet making is also dominated by the Chinese. And I think given the events of this year, people are very, very sensitive. People have certainly over the last 2 or 3 years have become a lot more sensitive as to where their supply chains are. We've seen several geopolitical events over that period increase that consciousness. And so if you want trade routes and supply chains to shift, you're going to have to incentivize that. And there are some areas, and we talked about rare earths, where the process of that incentification has begun, and you've seen individual stocks, benefit quite significantly from that, and there are some where it hasn't. And China dominates the world's processing of a number of metals, but you look at copper smelting and some other processing industries, and there aren't at the moment huge incentives being offered, and there is limited incentive to build new capacity in the West, and in the longer term, we're going to have to think about whether that's right or not, and how we change that.
Yeah. Now, another potentially geopolitical and definitely a political topic is the Trump presidency. Of course, we have seen the impact on the energy transition in the US, where less attention for renewable energy. But how do you look at that in terms of investing in the transition materials? Does that impact your strategy a lot?
It's a great stat in the BHP commodity review at mid-year. It said that China had installed, I think, as much wind and solar in the first 6 months of this year, equivalent to 90% of the wind and solar ever built in the US. And that is, mind-blowing. And you look at, quite significant rollout in other Asian countries. Africa is beginning to install sort of meaningful amounts of renewable energy as well. And so you definitely have some gives and takes. And even in the US, I'm not going to comment on policy, but you've seen some areas which have been much stronger than expectation, as well as some areas which are probably where our demand expectations have dropped a bit.
And what about the tariff war that we saw earlier this year? I remember you were speaking at one of our events in February, and there was a lot of questions around Trump, but the tariff war hadn't happened yet. And materials, commodities, it's a global trade. Did that get a bit of a knock around from that?
Well, obviously, you saw a lot of volatility in the first half of this year. And the lack of visibility was, I think, difficult for producers, and customers were kind of feeling their way to a degree. But kind of if you think about what you actually saw, speculation about copper tariffs led to a huge amount of the world's visible and invisible copper inventories heading to the US, tightening the global market, and so arguably was copper positive, and there's still a large amount of inventory sitting in the US, which would need shifting if it was to come available to China or the rest of the world. And tariffs can create new profit pools, and as well as reduce other ones. And so, I think for an active portfolio manager, you need to watch change. And when regimes shift, you need to be mindful, but more often than not, they create opportunities as well as risks.
Yeah, for sure. Now, Trump is not the only one that sort of affects the energy transition. We've also seen a lot more demand coming from the rise of artificial intelligence and use of artificial intelligence, especially data centers, where they're quite energy-hungry operations. How do you look at that? Is that affecting, you think, the transition? Could it derail it? Could it, delay it? What's your take there?
It's something that we factor into the way we think about commodity demand. And it's nice to have in many cases rather than utterly central to investment cases. And yeah, as I said, I think earlier, we see AI and data centers as competing with other significant structural drivers for, in some cases, quite scarce supply of commodities. So it's definitely for me a positive, but it's one of a number of positives. It's not a main driver, and it's not massively significant, particularly in copper today. So the relevance is still to come.
We have seen that some of the key players, such as Amazon and Google, they're looking now at nuclear energy generation.
Yeah.
And I think in some of the white papers you've written, you talk about uranium as potentially experiencing a structural demand renaissance?
And I think that's happening already, like, because obviously you had a long period of decline, from which lasted for a prolonged period of time, partly because of nuclear accidents in the past. But people have begun to understand that, particularly as you roll out renewables, you need a base load of low carbon power. And nuclear is an obvious source of that. And so you've seen, and again, like, the tech players are nice to have and are definitely additive to the demand story. But what you've also seen is a series of governments change their view around nuclear, and in some cases make U-turns. And you've seen again, like, China just drive nuclear power growth, which leads to significant amounts of uranium demand. And then longer term, obviously, and it's tomorrow's story rather than necessarily today's. You've got the innovation of small modular reactors, which I think change the use case for nuclear and are a tremendously exciting potential innovation.
So how do you look at nuclear, or more specifically uranium as the material, in the context of your strategy? Because I could imagine that some people also invest in this type of strategy with an element of ESG in the back of the mind. It's not necessarily an ESG strategy, but there are elements there where you can think the E is obviously very relevant when you invest into the energy transition. But at the same time, uranium also has dual use. It has some issues with pollution. How do you look at it from that angle? Do you get questions around that?
Less than you'd thought. Sustainability is important to us, and I kind of often say that I've been an ESG analyst for a lot longer than most, because if you think about metals and mining, it's inherently an impactful activity, but a lot of what we could now call ESG have been business issues for the majority of my career. Availability of water, how you get on with the local communities. They're not new issues just because we now call them ESG. And so this has always been a part of how we think about stocks. Safety. If you're running an operation properly, you should be able to keep your employees safe. And so we apply those same frameworks to uranium companies. We don't punish uranium for its potential use in weapons, because we do see it as critical to the transition.
Yeah. Now, if we delve a little bit into the way you approach investing in this space, this is not a commodity strategy necessarily. You invest in stocks, you invest in equity. Why do you choose this route and not go to the raw materials?
I feel quite passionate about this because I really feel that commodity-based strategies are the wrong way to do this, and there are various reasons for this. One is I think liquidity can force you to make compromises and to go into areas that you don't necessarily want to go into, because in several of the interesting areas that we're talking about, there isn't really a liquid instrument to play. I mean, rare earths is a good example. Very difficult to play as a commodity. And then well, I would say this as an equity person, but the way that we choose stocks is focusing on ideally the low cost, high quality assets, ideally with growth, with solid capital allocation, and we're looking ideally for assets that generate free cash flow through the cycle. And so, for instance, you can own a commodity, but if you own a low cost producer of that commodity on a flat commodity price, you can earn quite a decent carrying yield. And obviously, if the commodity then does what you expect it to and goes up, then you have leverage to that. And if you're growing as well, then you get further leverage. And so, as long as I think you are picking the right kind of stocks, I will always believe that equities is a superior way to do this than commodities.
And how do you sort of limit or define your universe? Because we talked earlier about animal fats. I know I think wood pulp as well is in material in your portfolio. How do you sort of limit it to the relevance to the energy transition?
We've intentionally looked widely because I think you can think about the thematic too narrowly and the impact it's going to have on our lives. Getting to where we need to get to is not narrow, and so we are constantly looking for new areas, and particularly less well understood areas. Chemicals is a really good example in that you have there a space where you ask management teams about the relevance of transition to their portfolios, and I haven't yet got that many really good replies. And so chemicals is an example of, so we're looking to expand the universe rather than contract it, because we think that the opportunity set is even wider than we've envisaged. And as you say, we've construed the opportunity set as more widely than most.
Yeah. What sort of chemicals are involved in the energy transition?
Well, this is the point. Is that I don't think that people have a good grip on, polysilicon's an obvious one, where there's demand benefits in solar. But in the same way as copper goes into all these applications, it can't be true that there aren't a wide range of chemicals that are driving this in a way that I don't think is sufficiently understood.
Yeah.
Silicones also, go into a. You also see demand benefits in silicons. So it's. They are there, but just it needs some finding.
Yeah. Is there any applications in, say, coolants, or is that just water?
It's very. The thing I really like about talking about this area is everybody I talk to gives me ideas, and you've given me something to go away and work on.
All right, fair enough. So when you look at this area, there's obviously a lot of commodities involved. There's a lot of metals involved. We're sitting here in Australia talking about this topic, and obviously Australia is a very mining-heavy, commodity-heavy economy. To what degree does this strategy correlate with, say, an Australian equities portfolio?
As far as commodities share demand drivers, and particularly in terms of China, there should be some correlation, particularly with the mining slice. I think over time, copper and commodities that are geared to this thematic, in my view, should outperform some of the commodities which are more geared, I think, to the previous supercycle rather than the next one. That's my view anyway.
Yeah, so we have a lot of iron ore here, which obviously is not as correlated, but also lithium.
So lithium obviously sees tremendous demand. And this, I've talked about supply being as important as demand, and understanding the supply side being utterly critical to this. And and lithium is a commodity where the Chinese are brought in on an immense amount of supply, and so economics in that industry have been pretty challenged. Long term, assuming that lithium continues to grow at a sort of advanced CAGR, then we have to keep on bringing on new supply, and so that has to be incentivized somehow. And so I see the future for lithium as being brighter than it is today, but not necessarily anytime soon. Although things can change so fast, and we've seen a couple of months ago, suddenly everybody was talking about anti-involution in China and the need to make industries profitable. And so things can change pretty fundamentally very, very quickly. And that's why I think you need an active portfolio manager keeping an eye on this and reacting as things change rather than more passive strategies.
Yeah. Do you also keep an eye on sort of like new materials coming out? I mean,
I keep an eye on everything. I'll be honest. Like it's like that's why it's insanely exciting and interesting space, because you see these innovations, and the majority of things that you see can't go nowhere. Yeah. Some of them are uninvestable, but things can change, and you particularly need to keep at the moment an eye on what's happening in China, because so much innovation is happening there. And so, this is a space that's characterized by innovation and change. And so reacting to that and sensing the opportunities as they come and the threats as they come as well is part of the day job.
Yeah, because there is a lot of innovation in this space. Like I think a couple of months ago there was a lot of chatter about superconductors, and that we're getting closer to that. That would be a game changer, I presume, to this space.
Well, and people talk about game changers in the nuclear area as well. And so in a number of these cases, the world may well get there, but it's whether it's 5 years, 10 years, 15 years. It's you can see the way the world's heading. It's when we're going to get to that destination is often unclear. And some things will get there faster, but in many cases things just get pushed out.
Yeah.
I saw a really interesting stat the other day with great minds predicting innovations, and the innovations they predicted were almost always correct. Their prediction was just too early.
Yeah, that's the question, when to jump into a particular material as well, because
and so that is really, really important, because you can lose enormous amounts of money in investing in a great demand story that is just uninvestable near term. Because that's why I said again and again and again, you need to think about demand, but you need to think about supply almost as much as demand, because I don't want to lose money for 2 years and be right in 10. I think it's really important to invest in the long term, but with a short-term focus.
Yeah, because we looked a little bit into where we're at with nuclear fusion, and one of the approaches that has been tried here in Australia uses boron. But I presume it's a little bit too early to jump into boron at the moment.
Like boron's something I look at every now and again, and I haven't found, and I can see why it'd be exciting, but I haven't got to the stage where I'm excited enough yet.
Yeah.
But and if I think about the first time I found it exciting, I'm very glad I didn't invest at that point, because it would not have been exciting.
Fair enough. So I asked you about the correlation with Australian equities, because obviously this can function as a bit of a diversification strategy. When you look at investment styles, where do you think this has overlap? Because you could imagine that some of these commodity plays could potentially be value stocks, a bit of the cyclical companies there. Does that turn out to be true? Is this sort of a value play?
I think if you look at the way that we invest, it's very much valuation focused, but with a strong quality overlay, in that we want to be in good assets. We don't love leverage on the balance sheet, and so I mean, I think if you look top down at the portfolio, it screens well for value, and as you say, multiples are different across different commodities. So yeah, from a top down basis, we screen as value, but if you look under the lid, it's a little bit more complicated than that.
Yeah. So this strategy plays into the energy transition, and of course, the purpose of the energy transition is to basically decarbonize the economy, the global economy. But how does this sit next to sort of a decarbonization goal or an emissions reductions goal? Because, the production of some of these materials are potentially quite intensive in that perspective. How do you think about that?
Yeah, I mean, this is the consistent irony, is that it's a lot of, on the face of it, the carbon footprint of the portfolio is higher than you'd like it to be, because these activities have a physical footprint. There's heavy processing, and there's trucks, and there's a significant amount of emissions involved, but and those emissions are more for some commodities than they are for others, but these commodities, we think, are necessary to unlock the transition. And so, the view we take is that, we are willing to take that footprint in the short term, but in the longer term, we're looking for producers to reduce their emissions and to get and to have a realistic pathway to a better point in the future.
Yeah, it's sort of along the same lines as, if you have a portfolio of windmills, it's not necessarily low carbon, but obviously it's going to help with the energy transition.
Yeah, but I think direction of travel is also really important.
Yep.
In that, there are in most cases there are ways to decrease that footprint quite materially, and so you want to see companies working along that path. And kind of helping and sponsoring innovation to help with the remaining emissions where it's more difficult to shift.
Yeah,
and that's why, so we think about scopes 1 and 2, but we think about scope 3 as well, because supply chain emissions are important, and the extent to which a company can influence its supply chain emissions, is something that we think about a lot.
Your strategy does sometimes get compared to other climate solutions out there in the market. And I think you're quite passionate about the fact that you have a different way to approach what you see as the enablers of the transition. Can you tell me a little bit about that?
Yeah, I think there are many valid ways to approach this, but I think you need to know what you're doing, and I think it's quite difficult to have the same level of expertise in the commodity space and in the technology space. I think the very different multiples, the risks and the challenges are different across both. And so I think a more focused strategy in both areas kind of makes sense. And, the thing that I love about the way that we're doing it here is that if you have the transition developing faster in China and the East, versus the West, from the technology side, I think the winners and losers are different because, Chinese decarbonisation is not necessarily going to use Western providers. In fact, it's most unlikely to, and vice versa. Whereas if you're going to consume a unit of commodity, it doesn't really matter where that unit's been. Well, in many cases, it doesn't matter where that unit is being consumed.
Yeah, I think you said in a previous conversation, I don't care where the copper is sold as long as it's sold.
That's probably more brutal than I was intending to be, but in the spirit, I can understand why I said that.
Fair enough. We might finish up with a bit of a left field question. We were close here to Martin Place, and there's like 400 people lined outside of the gold place. Now, there's some limited applications of gold in industrial use, but is this a transition material, or is this not in the portfolio?
I know. I mean, there's been many times this year where I wish that we thought that gold was a transition material, but I think the relevance is minimal. Silver, obviously has some applications in photovoltaics in particular, and you do get. So there's a fair amount of gold in the portfolio because gold is often produced by by companies who also produce silver, and also companies who also produce copper, and so there is gold exposure in the portfolio. But do we target pure play gold companies? No, because we don't think that kind of thematically pure.
Fair enough. Well, James, thank you very much for this conversation, and thanks for coming to our offices.
Well, thank you very much for having me.
This podcast was sponsored by Fidelity International. As such, the sponsor may make suggestions for topics, but final control remains with the Investment Innovation Institute. Thank you for listening to the i3 podcast. For more information, please visit our website at www.i3, that's the letter I, the number 3, analyst-driven-invest.com. And don't forget to like, subscribe and review. Thank you very much.